Welcome to this quick training on financial statements, provided by the Utah Association of Public Charter Schools. This training will cover the basics of the most common financial statements and how to read and use them. This is meant as an introductory course to assist you in your duties as board members of charter schools. Financial statements make up the pieces of your school's financial puzzle and are critically important to seeing the whole picture of how the school is operating. They tell you where your money is going, where it's coming from, and how much you've got to work with. They're very helpful for making smart decisions, and they're 100% necessary to comply as a public entity or if you want to bond. Financial statements summarize important financial accounting information about your school. There are three main financial statements: the balance sheet, income statement, and cash flow statement. Together, they provide a clear picture of your financial position. Each month, your board should review the financial statements. Let's look at what each of these three basic financial statements do and examine how they work together to give you a full picture of your school's financial health. The balance sheet is the most basic of the three statements. It shows you a snapshot of your finances at a particular point in time, how the finances currently look. Some large businesses with lots of transactions balance every day. Most small sole proprietorships balance quarterly. As a public charter school with fixed monthly revenue, you should expect a monthly balance sheet. Even if your board meets less frequently, it is reasonable to ask the business manager to balance the finances monthly and present the statement for review. You're probably very familiar with a balance sheet. Your own online bank statement is a balance sheet. If you want to go out to lunch, you may check this report to see if you have enough in your account, or if you need to transfer money or just pack a lunch. Even though you understand this report is fluid and money will still be coming and going, this snapshot in time helps you decide. Balance sheets are broken up into three general categories: assets, liabilities, and net income or equity. The formula that drives your own account is balance equals deposits minus withdrawals. The school's is the same basic concept using different terms. Equity equals assets minus liabilities. Pretty simple, right? A balance sheet should be simple. Remember, this is a snapshot. Even so, let's make sure we understand the new terms. Assets are anything of value that your school owns. Of course, this is money in a checking account and money in transit from another account. But total assets can also include things like equipment, furniture, land, buildings, notes receivable, and even intangible property such as patents and goodwill. Most schools are only going to have a few accounts listed, a checking and an investment account mostly. Liabilities are debts you owe to other people. Total liabilities can include loans, credit card debt, mortgages, and accrued expenses such as utilities, taxes, or wages owed to employees. This is a list that is usually a little longer. You will have a lease or bond, P cards maybe, and accrued expenses for sure. Net equity, then, is the remaining value of the school after subtracting liabilities from assets. Even though your organization is a nonprofit and is operating to provide a service through public consumption, you must have a minimum of 30 days cash on hand. The balance sheet is a great way to do a monthly check of those days. Although not typically one of the items listed, ask your business manager to add it. And then as a board member, quickly do the math each month. Does the balance accurately reflect the days listed? The bottom line of the balance sheet, the school's value, is based on what you own minus what you owe. Let's look at a very simple balance sheet. At the end of the month, you get a balance sheet from your business manager. It looks like this. At the end of the next month, your balance sheet shows this. Nice. You've added $101,000 to your net income and now have 34 days cash on hand. This is useful information, but it's not the full picture. Does your balance sheet tell you how many students you are being funded for? No. How much revenue you receive? No. How much it costs you to educate the students? No. How much you spent on classroom expenses? No. This is where the next type of statement, the income statement, comes in. The income statement allows us the details we need to make informed choices. While the balance sheet is a snapshot of your financials at a point in time, the income statement shows how profitable your school was over an accounting period, typically a month. It shows you how much revenue the school received from all sources and how much you spent on all the various expenses. A note on the name here. This report used to be called the income statement almost exclusively, but many organizations produce a variety of versions of this report, calling it various names, such as a budget report, profit and loss, income and expense, etc. No matter what it's called, this statement shows the organization's revenue and expenses for a specific period of time. The report reflects the changes to net assets during the current fiscal period. At a school, the profit or loss is called the change in net assets. Of course, we want this number to be positive. Restricted funds, more on that later, can make understanding and managing the income statement tricky, but at the end of the day, the function is the same. Where did the money come from, and what was the money spent on? And what was the change in net assets? You may be thinking to yourself, we're a nonprofit, and so this report or concept doesn't apply. The difference between income and expenses still matters, even if it's not technically a profit. Recall, you must have at least 30 days cash on hand. And if your monthly net change is always negative and you are spending more than you can bring in, it will not be long before you can no longer maintain that requirement. Let's look at a real-life example. The school brought in $1,000 of revenue from various sources. What does the income statement tell us that the balance sheet doesn't? It tells us which category our revenue is listed under, federal versus state versus local. It tells us how much is restricted versus unrestricted. It tells us how much we budgeted for versus really received or spent. And it categorizes our spending. But what is missing? Does your income statement tell you how much money you have in the bank? No. How much money you owe to the state for your P cards? No. How much money you had 1 month ago versus 6 months or a year ago? No. To get that information, you need snapshots of your business's finances, and we got those from the balance sheet. Because school revenue must be accounted for using a modified accrual basis, I'll explain that in just a second, your board may also need one more statement, a cash flow statement. The cash flow statement tells you how much cash entered and left your business over a particular time period. Cash flow statements are typically only prepared for companies that use an accrual accounting method. And as a public school in Utah, you are required to use a modified accrual basis. Modified accrual is required because under this accrual method, the school's income statement might include revenue that the school is entitled to but not yet received, and expenses the school has incurred but not yet paid. Restricted revenue from the federal government is one example of revenue that the school is entitled to but may not have yet received. And teacher wages to be paid out during the summer is an example of an expense the school has incurred but not yet paid. Modified accrual accounting is used and accepted by governmental agencies because we focus on current year obligations. Governmental accounting has two key objectives: to report whether current year revenues are enough to cover current year expenses, and to demonstrate whether resources are being used according to legally adopted budgets. Modified accrual accounting ticks those boxes. Modified accrual also enables the school to focus on short-term assets and liabilities and permits you to divide available funds into separate entities within an organization. Think special education. And that ensures that money is being spent where it was intended, either by board-approved budgeting or by the restriction placed on the funds by the entity providing those funds. More on this later. Most of the time, a program report will capture the details typically provided by the cash flow statement. Either way, ask your business manager for a report to show that the money allocated to each specific program, like title funds or SPED, is being spent in the correct period and according to plan. We've covered a lot of information about 3 different types of financial statements in a really quick amount of time. So let me give you a pro tip. Ask questions and get data. As the board is looking at income statement in particular, you really want to dig into it and ask questions. And if it looks sketchy, get some backup documentation. We're going to practice now. Let's say it's March, which means how much of the year is exhausted? 75% of the year. Why do we care what percent of the year is over? Well, it provides a yardstick against which to measure the percent of change that we have in our budget against the overall budget. Does that mean by this time in the year, all categories in our budget should be at 75% change? No, it's just a gauge. Some expenses may have come 100% at the beginning, like textbooks or supplies, and others will come more toward the end. Still, ask the questions, get the data. Based on the year being 3/4 of the way over, let's look at some examples of the income statements. Should only have received 50% of your federal revenue concern you? Most likely not. Federal revenue, like IDEA and title funds, typically start to come as reimbursements in the late winter, early spring months. All students are general education students being funded by the state before they're to be funded by federal dollars. So you can ask for reimbursement after plans have been submitted and approved and restricted expenses demonstrated. So to only have recouped half is pretty normal. Your business manager should provide regular program reports showing the balances in each program. The budget is usually available long before this time, so your budget should be close to accurate by this point in the year. But still, ask the questions. Your state revenue is exactly at 75%. How can the state be 100% accurate at this point? Your initial budgets are provided in the spring of the prior year in order to allow your board to pass their budget by the June 30th deadline. So you will know how much you're getting based on the reports provided by school finance. Does this mean that they never change, even if your student count changes? No. Budgets are planning documents and can, will, and should change. Your allotment from the state can and will change a few times during the year, typically in November and February. But you should be reviewing budget to actuals each month. By March, your budget should be fixed and that amount of state revenue received. Keep in mind, though, payment for the prior month is received on the last day of the month, so March's revenue will be received on March 31st, which is why it is probably best to meet after the 15th of each month so that your business manager has time to prepare timely statements. Look, you are only at 67% of budget in salaries and only 40% in admin specifically. That's great, right? Look at all that money we've saved. I'd be asking a lot of questions here. This is not necessarily good or bad. I would just want to know why. Maybe we did save a lot of money. Perhaps a really expensive teacher left and I have a long-term sub in his place. Or maybe we didn't fill the school like we planned and so we didn't need all the staff we planned for. Maybe we planned for 2 admin and just got 1 amazingly overworked one instead. I just want to know what is going on so that those numbers make sense. And if it's the first time this is coming up, get the backup documentation too. Your budget should already account for the accrued wages. Why is instruction at admin broken out? In program accounting, more on that later, we need to track if the money is going toward classroom instruction, the office, counseling, the district office facilities, etc. So we break expense down into parts, and this is one of the parts. How many of you think 150% expensed at this point is bad? How many good? How many want to ask the questions? Yep, ask the questions. Get backup if needed. The 300 object code is purchased professional services. This includes professional computer services, professional development, educational services. There could be a totally reasonable explanation, but how will you know? What will be some of the questions that you can ask? What could you expect your business manager to provide you, given that the school spent a lot more than they should have? Some examples of questions could include, what function was this money spent in? What was the amount last month? Was this one purchase or several over time? Did the bid not match what we approved? Some examples of backup documents could be an explanation of more details, to see the month-to-month changes, maybe some documentation showing the adjustment, line items for change. What will the board need to do in response? Some options include reapprove the budget with that money coming from another pot, on unrestricted most likely, get a grant that will cover that amount, fundraise, can be hard to do, take from reserve, yucky, but you may need to, or expect the director to stick to the budget, or reevaluate the budget to see if the amount budgeted was too low. There is not one right answer, and context is always needed. Last one. Think about this one. At this point in the year, the school should be done buying textbooks and having printing done, so being 100% is probably not a huge deal. Maybe the school decided to have teacher-created workbooks printed instead of purchased. Maybe the budget was way off. Maybe the cost went down on one and up on another. Maybe the enrollment was not as expected, and so less textbooks were needed. But why so much printing? Ask, ask, ask. Not knowing the answers, either you or them, is so much worse than most explanations. And if your admin or business manager get offended by the questions or do not know the answers, get new ones. Set the expectation early that you will be asking questions and may even request documentation. We have covered a lot of material in a very short amount of time. We learned that a balance sheet is a snapshot at a particular point in time, and that this is a simple statement without a lot of detail. It is based on the premise that the school's value is based on what you own minus what you owe. We looked at the income statement and how it shows profitability over an accounting period. This statement gives us the detail we need. Recall that even nonprofits want a positive change in net assets. We did not look at the cash flow statement in too much detail because your school may or may not need one. However, your school must use modified accrual accounting methods. And if you don't use cash flow statements, you do need some way to see the money coming and going in the correct period and according to plan. We wrapped up with a pro tip to ask questions and get data, providing sample income statements to practice the skill of reading statements and asking questions. Be sure to watch the other trainings in this series to see how all the other components of school finance fit together. This training was brought to you by a grant from the Utah State Charter School Board.